Hello everyone. I'm sure that all of you can hear me properly. Okay, great. I won't go into much detail about me. My name is Ijaz Khan, and the rest of the information is on your screen. Well, as you know that we will be having 15 hours of revision session and 2 hours of the debrief mock. I will try my level best to cover as many key areas as possible during these 15 hours of revision. I will just request all of you to hold your questions. I will give you people time to ask questions, but till I give you the time for asking questions, kindly hold your questions so that we can maintain our smooth flow of the topics. And you can use your chat box for sending me messages when I ask you to do so. Before we start our today's topic, let's skim through the paper format, how the paper will appear in the exams. There will be 3 sections in the paper: section A, B, and C. And section A will have 15 multiple choice questions of 2 marks each, and the total marks for this section will be 30. Section B, it will have 3 small case studies type questions, and each of the 3 questions will have 5 multiple choice questions. In total there will be 15 multiple choice questions, and each of them will be of 2 marks. Again, there will be 30 marks available for this section. In total, 60% of your paper will be of multiple choice questions, and the rest of the 40% marks will be divided equally between 2 descriptive questions in section C. And in these areas, you will have to attempt these questions with the descriptive solutions. There will be no choice available in any of the 3 sections, so you'll have to attempt all the questions in the exam. As far as the section C is concerned, you can see that note, the 2 20-mark questions will mainly come from working capital management, investment appraisal, and business finance areas of the syllabus. And section A and B can cover any part of your syllabus area. There is a detail of the syllabus. In the brackets in front of every section syllabus area, it's mentioned that in which section of the paper will this topic be covered. For example, the financial management function will be only tested in section A and B of the paper, and section C will not consist of any question from this area. Similarly, for financial management environment, working capital management is the area which might be tested in any 3 paper areas, section A, B, and C. The same goes for investment appraisal. Same goes for sources of business finance, and the business and assets valuations will be only tested in section A and B of the paper. That is, you won't be having any descriptive question from this area. Risk management, again, you won't be having any descriptive question in this area. It will only be tested in section A and B, that is the MCQs. I will try to cover as many key areas of the syllabus as possible. We'll spend some time on the investment appraisal area of the syllabus, because it's a core area of the syllabus, one of the core areas of the syllabus, and it's actually the base of the whole financial management subject. So we'll spend some time on this area to build a base for the rest of the topics. So our today's topic will definitely be the investment appraisal. So there is a day-wise plan, but we'll try to stick to the plan, but definitely we have only 15 hours to cover the key areas of the syllabus, so we'll move accordingly. If you people have any questions regarding the syllabus or how we're going to proceed, you may ask before we can actually start the topic. Any questions from you? Yes, we will be, Dania, we will be covering working capital, and I will try my level best that we also cover the risk management area as well. Now, the first two areas of the syllabus, it's basically a theoretical area of the syllabus, and it's a very general area. And if you go through the study text, I think you'll find it very easy to cover once the whole syllabus is covered. Sumer will definitely try to spend some time on Forex as well. Well, as far as the practice is concerned, I will give you assignments for home assignments for MCQs and MTQs, so you may be able to practice it at home, but I will provide you those questions. Shakil, yes, I will be providing you people with some MCQ-based assignments as well. Yes, that all the areas that we are going to cover in this webinar, you will be provided with the handouts with the course material. Ali, you may go for any study text. It won't make difference. It's purely up to you. You just look at your own convenience. So both the Kaplan and BVP, they cover the syllabus areas in their own way. So you just look at your own convenience. So whatever textbook you like, you may follow it. Yes, we will be discussing the calculation and theoretical both parts. We'll be focusing on both areas. So we can't stick to the schedule because we have a limited time, so we'll try to cover as many key areas as possible, and it purely depends on how we progress through. Depends on the number of questions that you people may be asking. So we can't stick to the schedule, though the schedule is provided. If you can see the first few slides of this handout that has been provided to you, you can see a schedule there. Yes, I will create a WhatsApp group for sharing further handouts and any other questions if you people may come across. You may ask me on that WhatsApp group. We'll be creating that WhatsApp group, and we'll be sharing the link with that. And I'll also share my contact details with all of you. If you have any questions of the webinar session, anyone can ask me later on as well. Zainab, these sessions will be recorded, and you will be given access to the recorded webinars as well. I think we should start our first topic. Excuse me. Okay, we'll start with the investment appraisal, but before we go to the core areas of the investment appraisal, that is the net present value calculation, IRR calculations, payback, and other areas, we'll just start with the compound interest first, which is a very basic calculation that everybody should understand before we can proceed to calculations of net present value. Let's see how compound interest calculations are. Let's suppose that Mr. A wants to invest $10,000 today, and we usually denote today's time as 0. So at point 0, Mr. A is going to invest $10,000 at 10% per annum, compounded, that is the interest will be charged annually, compounded annually. So how much Mr. A will expect after 2 years? If at point 0 he invests $10,000, after 1 year he will get 10% of his investment as interest, which will be equal to $1,000, and after 1 year he will have a total value of his investment as $11,000. After 2 years, and in the second year, he will again get 10%, but this time he's going to get 10% of 11,000 as the amount of interest. So 10% of 11,000 will be equal to 1,100, and his total amount will now be equal to $12,100. So for this, most important in this calculation is that the second year's interest will be charged on the total amount of $11,000, that is the principal invested and the amount of interest earned in the first year. And this process of adding interest is called compounding. So in this example, the interest is compounded annually. So after every year, the interest is added to the principal so that for the next year, interest can be calculated. So the amount that Mr. A will get after 2 years is called sum, or we may call it future value. And we may denote it with capital S. The amount that he invested at point 0 may be called principal, or we may call it present value, and may be denoted with capital P. So if we try to find out, with the help of the principal, the amount that Mr. A is expected to receive after 2 years, we can just use this formula for compound interest, which is S is equal to P into 1 plus R raised to the power N, where N is the number of periods since interest is added annually. The number of periods in this case will be in years. So it totally depends on the frequency of the compounding. If the compounding is being done annually, the period will be in years. If it is done quarterly, the number of periods will be in quarters. So in this case, it will be annual. So the P is the principal amount invested, that is $10,000. The amount of interest charged annually will be 10%, that is 0.1. And since we need to find out the value of investment after 2 years, we just put power as 2. So if we solve this equation, we'll get the same figure, that is $12,100. So we can use this formula, and it's a very important formula, and you need to keep this formula in your minds, because we'll be frequently using this formula in our calculations when we'll be calculating a net present value, and or we'll be calculating the IRR. We might be using this formula very frequently. Now, the basic thing that we need to understand is the difference between the principal and the sum, that is the present value and the future value. Remember, future value means you are going to add the amount of interest. And if we are to calculate the principal or present value, we are actually going to deduct the amount of interest accrued during the period. So the basic difference between present value and the future value is the amount of interest charged during the period. So whenever in an exam question we are supposed to calculate the present value, we will be actually offloading the interest. And if we are to calculate the future value of any investment, we will be actually adding the amount of interest into that. So there's a question on your screen. I would like every one of you to solve this question for me. What do we need to find? We need to find the total value of investment after 2 years. S is equal to P into 1 plus R raised to the power N. So P in this case is the amount invested at 0.0, which is $7,000. Interest rate is 10%, that is 0.1. And since we need to find out the value of investment after 2 years, so we'll take the power as 2. So if we solve it, we get $1,210. So this is the future value. So we have actually invested $1,000 and we are getting 1,210. The difference of the two will be the amount of interest. It is $210. So the basic difference between the present value and the sum, the future value, is the amount of interest charged during that period. So there are two questions right on your screen. Just go ahead and solve both questions. Yes, I guess the answer for the example 1 is $8,000. You're right. So let's go through example 1 first. A company is considering to invest X dollars at 10% per year for 3 years. After 3 years, it is expecting to receive a total of principal plus interest, which is $10648. Calculate the value of X. And what is X here? X is the amount of investment. That is principal. So we need to find out the present value or the principal amount in example 1. So the formula S is equal to P into 1 plus R raised to the power N. In this formula we have S here, 10648. We need to find out P. The rate of interest here is 10%, 0.1, and the number of years will be 3. So if we solve it for P, the answer will be, is it $8,000? Yes, it's $8,000. Okay, let's go to the example 2. A company is considering to invest $15,000 at X%. This time X is actually the rate of interest. It is R per year. Simple interest for 4 years. After 4 years, now make it a compound interest. It's not simple interest. Make it compound interest. Just a slight correction. Make it a compound interest, and let's solve it assuming that's a compound interest. So per year for 4 years. After 4 years, it is expecting to receive a total of $19662. Calculate the value of X, that is the rate of interest. So let's see, the amount of investment is $15,000, which is P. P is equal to $15,000. S is equal to 19662. N is equal to 4, and we need to find out R. So the formula is S19662. P is 15,000. R is what we need to find out, and it's the power 4. So firstly, we'll divide 19662 by $5,000, and let's see what's the answer. Can I have the answer of 19662 divided by 15,000? It's 1.310, right? And it's 1 plus R raised to the power 4. And we all know that we can't open up this bracket unless we remove this 4. So to remove this 4, we need to take power 1 upon 4 on the other side. So 1 plus R is equal to 1.3108 raised to the power 1 upon 4. So if we do it, what's the final answer? Can I have the final answer? 0.07 and minus 1. So it will be 7%. So R will be 7%. So any questions? Okay, let's move forward then. Effective rate. It's another very important calculation and an important concept. Suppose that a bank lends money at 10% per annum, but charges interest semi-annually, which we call compounded semi-annually. So it's charging 10% per annum, but it's charging its interest after every 6 months. So for a complete year, the interest rate will be 10%. But since this company is going to charge interest after every 6 months, the interest rate for every 6-month period will be 5%. So what is going to happen? Say, for example, if Mr. A invests, Mr. A borrows $1,000 today at 0.0. What he is expected to pay after 1 year. So what is going to happen is that the bank will charge him with an interest of 5% for the first 6 months, and 5% of 1,000 will be $50. And then for the next 6 months, that is after 1 year, the total amount will be 1050. So after 6 months, he will be again charged with 5%, and after 1 year, his total amount will be, the amount of interest charged will be 1050 into 5%. Can I have 5% of 1050? 52.5. Yeah. So for the first 6 months, the interest was $50, and for the rest of 6 months, it was 52.5. So if we add both together and see what is the total amount of interest, 50 plus 52.5, so it will be $102.5. So the total amount of interest that Mr. A is expected to pay will be 102.5. Now if we just try to convert it into a percentage figure, that is, Mr. A borrowed $1,000 and is expected to pay a total interest for the year as $102.5. So if we need to find out how much he's paying as a percentage of his investment, his borrowing, it will be 10.25%. Though apparently it was stated that the interest will be 10%, and this is called nominal rate. But effectively, Mr. A is paying 10.25%. This is called effective rate. So effective rate is actually the actual amount of interest that a borrower is expected to pay against its investment. If we want to calculate this using a formula approach, we can use this formula. Effective rate is equal to 1 plus R raised to the power n minus 1 multiplied by 100. So we can use this formula as well. The R in this formula will be the interest charged during the compound period. That is, in this case, it's the semi-annual interest rate, which is 5%. So 1 plus 0.05. The power here represents the frequency of compounding. That is, how many times in a year the interest has been charged. So may I have the frequency of interest charged in this example? What should be the frequency? How many times the interest has been charged in this example? 2, yes. So the power should be 2 in this case, as the interest has been charged twice in a year. multiplied by 100. So the final answer will be 10.25%. Same as we calculated here. So we can also use this formula for calculating effective rate. So make sure to put the right figure in place of R, and sometimes we might be asked to adjust this figure. That is, the given interest rate might be the nominal one, that is 10%. So we must first adjust this according to the way the interest is compounded. So for example, if it is compounded semi-annually, we need to divide this per annum figure with 2 to get the semi-annual interest rate figure. Similarly, if the compounding was done quarterly, we would have divided this 10% by 4, and in case of monthly, we would have divided it by 12 to get the monthly interest rate. Just solve these two questions on the screen. Sama, in case the interest rate changes during the year, say for example for the first 6 months it's 5%, and for the rest of the 6 months it's say 6%, then we need to calculate it manually to find out the amount of interest that Mr. A is expected to pay for the complete year. So for example 1, we don't need to adjust this 3% figure, as this figure is already quoted in quarterly terms and the interest is charged on a quarterly basis, so we don't need to adjust this figure. So we can straight away put this in place of R, 0.03, and since the interest is charged quarterly, it means it will be charged 4 times in a year. So the power here will be 4 minus 1 multiplied with 100. So it will be 12.55%. So the effective rate will be 12.55% in this case. Let's come to the question, example 2. It's example 2. Calculate the effective rate for 12% per year compounded quarterly, and this time it's the rate quoted is on a per annum basis, whereas the interest is charged on a quarterly basis. So it means that we need to adjust this 12% figure. Since the rate is on a per annum basis, but interest is charged on quarterly basis, so we have to divide 12 by 4 to get the quarterly interest rate, which is 3% per quarter. So we'll need to put 0.03 in place of R rather than 12%. And the power will be 4, as the interest is charged on a quarterly basis 4 times a year, and then multiply with 100, we'll get the same answer as 12.55%. I hope everybody has got it. So should we move forward? net present value. Now, why do we calculate net present value? What does it indicate, and where do we use it? Well, it's one of the appraisal techniques that we use before we take any investing decision, especially long-term investing decision. For example, a company needs to make a decision regarding investment in a machinery, but it's not sure whether it should go for investment or not. So it will have to evaluate this investing option using techniques called investment appraisal techniques. And one of the investment appraisal techniques is the net present value. The net present value technique indicates a company whether to go for a particular investment or not. So we'll see how it works, but first of all, we just need to understand the basic concept of the net present value. Before I go to the net present value concept, I will just explain a concept which we will be discussing in detail later on, is the cost of capital concept. Every investment in company has a cost. Whether that investment has been obtained through raising share capital, that is issuing shares, or that has been obtained through a bank loan, both type of capitals will have some cost attached. If you issue shares and raise capital, you have to pay dividends and capital gains against the investment made by the shareholders. Similarly, if you have raised the capital through debt finance, that is, you have obtained a bank loan or you have issued debentures, you have to pay interest against debts. So whether it's equity finance or it's debt finance, you have to pay against these two types of sources. The average cost that a company has to bear against the capital is called cost of capital. Suppose that we pay 12% against our equity and 6% against debts, and both of these sources are equal in terms of their proportion into the total capital. Say 50% of the capital is through equity, 50% of the debts capital is through issuing debts. So we have 50% of equity and we have 50% of debts in our total capital. So if we take the average of 12% and 6%, in this case we'll get 9%. If we add 6 plus 12, that is 18, divided by 2, we get 9%. So the company on average will be paying 9% on its capital. What does this mean? It means that the company should make sure that it earns at least 9% from every investment so that it can pay this 9% to its fund providers. So every investment project should have at least 9% return before it could be accepted. Let me quickly give you a recap, because I guess my voice was lost. Cost of capital. So let me go to what is cost of capital. I'll show you with figures. It will be easy for you to understand. Let's say a company is going to borrow a total capital of $100,000. It needs $100,000 of capital for a project. And suppose that 50% of this capital will be raised through issuing shares. So $50,000 will be raised through equity. that is issuing shares. And the rest of the $50,000, which is 50%, will be raised through debts. Against the equity, the company has to pay, suppose it has to pay dividends, and the required dividend by the investors is, say, for example, 12%. So it means that the company has to pay 12% of the $50,000 as its dividends. And suppose that the investors who have invested through, say, subscribing for debt instruments like debentures, they require annual interest of 6%. So if you just calculate how much of the dividend company is expected to pay against the $50,000, may I know what figure it will be? What if the company is paying 12% against $50,000? 12% of $50,000 will be $6,000. Yes, right. So the company will be paying dividends equal to $6,000 against $50,000 of investment. And what if we take 6% of the debts, that is the amount of interest that the company is expected to pay? It will be $3,000, right? So it means that the company will have to pay a total of $6,000 plus $3,000, which is equal to $9,000 against the capital it acquired, which is $100,000. So it has to pay $9,000 against the total capital of $100,000 multiplied with 100, if we'll get the answer in percentage terms, 9%. So it has to pay an overall 9% return against its capital of $100,000. This is called the cost of capital. So this 9% is actually the cost of capital of the company, as it has to pay 9% of $100,000 as a return for the investors. I hope it's clear now. Yes. Now what if a company gets an opportunity to invest this figure in a project, say project A? What do you people think? Should this company go for project A if it is generating less than 9% return? Yeah, no, it should not go for any project that generates less than 9%, because it has to pay at least 9% to its investors. So the company is going to make sure that every project it accepts generates at least 9% or above to make that project feasible for the company. So I hope that the basic concept of the cost of capital is now clear. Yes, 9% will be the minimum required return for the company. So let's look at this. Let's look at this example. Mr. A is considering to invest a sum of $10,000 in a one-year project. After the end of the project, he will receive a total of $12,000. If his cost of capital is 10%, that is the minimum Mr. A wants to generate, what is the net present value of the project? Forget about what is net present value at the moment. Just concentrate on the figures that have been given in the question. Mr. A is required to invest $10,000, and he's considering whether to invest $10,000 in this project or not, as he knows that he will be receiving $12,000 after the end of year one, which is the life of the project. He needs to make sure that he is earning at least 10% from this project. Now let's do some calculations to understand what Mr. A is gonna do. Mr. A will get $12,000 after the end of year 1. Right? Now he is considering whether he should invest $10,000 in against these $12,000 today or not. For the time being, just forget about how much is required for this project in this case. We just need to find out how much Mr. A should invest in this project. We need to find out first, we just need to find out that figure first. And then we will compare that figure with this $10,000 later. So firstly, we need to find out how much maximum Mr. A should invest against the $12,000 that it is going to receive after year 1. Now remember, he has to make sure that he earns 10%, at least 10%. So what should the maximum value of investment be which makes sure that he earns 10%? Suppose that he is investing X dollars against these $12,000. So what he would like to have at the end of the year, he would like to cover the amount he is investing, that is X dollars, plus 10% of whatever he has invested. So he needs to make sure that he earns a total of his investment plus 10% of his investment. So the total amount that he will receive should be X plus 0.1X, and in dollar terms it should be equal to $12,000 which he's supposed to receive. So what he's going to do is to find out that value of X that he should invest at max to cover its cost of capital. So can I have the value of X in this case? What should the value of X be which will make sure that he earns his 10% minimum required return? So 1X plus 0.1, it will be equal to 1.1X. So if he wants to generate 10% return from $12,000 that he's going to receive, he should invest a maximum of $1,0909. What does this mean? It means if Mr. A invests $10,909 today and receives $12,000 after year 1, he will be able to cover its cost of capital. Is it okay now? Okay. So Mr. A needs to invest $1,0909 today against the $12,000 that he is going to receive after year 1, and in that case he will be able to generate 10% return. Just to check whether this figure is correct or not, let's see what will happen if Mr. A invests $1,0909 today. If Mr. A invests $1,0909 today and he wants 10% of 1,0909, what that amount will be? Can I have 10% of 1,0909? $1,091. Okay. 1,091. That is the amount of interest that the amount of return that it wants to generate, right? So 1,091 plus 1,0909 that he has invested. Is it equal to 12,000? Yes, it is equal to 12,000. So now it's confirmed. If he invests 1,0909 today, and he wants to generate a further 10% of 1,0909 from this investment, he will be requiring a total of $12,000, which is actually what he's going to receive after year 1. So if he invests 1,0909 today against the $12,000 that he's going to receive tomorrow, he will be able to receive his 10% return. So this is the maximum that he would like to invest for this project. Now let's compare it with the required investment in this question. The amount that he wants to invest at max is 10909. And the required investment, may I know the required investment in this question? What's the required investment in this question? 10,000, yes. So even if Mr. A invests 10909 today, he will get his 10% return. And the question, according to the question, the required investment is just $10,000, which is well below the amount that he is willing to invest. And the difference is $909 positive. So my question to all of you is, should Mr. A invest in this project or not? Yes, because he wants to generate 10% return. And if he wants to generate 10% return, he has to invest 10909 in the project, whereas the required investment is 909 below the maximum that he should invest, so he should go for it. He should go for it. And then let's see what this figure is. What we have done is we have just simply calculated the present value of the 12,000. It's the present value of the $12,000, 10909. And let's see if we use a formula of present value, which is P is equal to S. Sorry. Let's see if we can calculate this figure with the help of the formula that we have learned, which was S is equal to P into 1 plus R raised to the power N, right? The sum here is 12,000. P is what we need to find out. R is the 10%. And N is 1. So just use this formula and calculate the P. Can I have the value of P using this formula? It's same, 10909. So we don't need to use this lengthy approach to calculate 10909. From now onwards, whenever we will be required to calculate the present value, that is to find the maximum that should be invested, we need to use this formula. So 10909 is the amount that Mr. A should invest at max. Now, my question to all of you is, how will you treat these $12,000? Will you treat it a cash inflow for Mr. A or a cash outflow for Mr. A? It's the cash inflow because it's something that Mr. A is expecting to receive after year one. So it's the cash inflow. Okay. So can I call this 10909 as the present value of cash inflow? Yes. And in other words, we can say that this is the maximum that one has to invest against the given cash flow, that is $12,000, if one wants to earn a return of 10%. So this is the present value of cash inflow. Okay. The required investment is $10,000. How will you classify this cash flow? Will you call it classify as inflow or outflow for Mr. A? It's the cash outflow, right? It's cash outflow. And since this cash outflow is required as of today, that is at 0.0, so we can also call it present value of cash outflow, right? Can we call this $10,000, which is required at 0.0, as present value of the cash outflow? Yes. So 1090 is the present value of cash outflow. Sorry, cash inflow. It's the present value of cash inflow. Whereas 10,000 is present value of cash outflow. And the resulting answer is the net of these two present values. That is why we call it net present value. 909 is the net present value. And when we looked at this 909, which was positive, we decided to go for the project. So that should from now onwards be the decision rule, that whenever the net present value turns out to be positive, we should go for the project, and whenever it turns out to be negative, we should leave the project because it is requiring more investment than we should invest. Is it clear? So remember from now onwards that the present value of cash inflow represents the maximum amount that a company should invest if it wants to generate a required return. And then this maximum amount should be compared with the actual required investment in the question. And if we see this maximum amount to be higher than the actual required, we should go for the project. And if we see the actual required level of investment as higher than the maximum that we should be investing, we should reject the project. So just go ahead and solve this question, calculating net present value. So the first step should be to calculate the present value of cash inflow, that is the amount that should be invested at max to cover the cost of capital. Present value of cash inflow. So let's find out what's the present value. What's the cash inflow actually? The cash inflow in this question is $13,000. So we need to find out the present value of $13,000. The formula will be 1 plus R, that is 0.1. Since we need to find out the present value, we need to write the power sign as -1. So for every present value calculation, the power sign should be negative. So it's $11818, and now $11818 represents the maximum amount that this company should be willing to invest against the $13,000 that is going to receive. Now we'll compare this $11818 with the actual required in the question, that is $12,000. So the investment required in this question is $12,000, which is higher than what maximum the company should be investing. And the difference is $182 negative. So since the net present value is negative, the company should straight away reject this project. Is it clear? Okay, good. Okay, go ahead and solve this question. Now it's a 3 years project, remember. The earlier two examples were projects with life of 1 year only. Now it's 3 years project. I will solve this question once I get 3 answers at least. Okay, great, I've got 3 answers. Let's calculate it. First of all, we need to find out the present value of cash inflows. The cash inflows are $22,000. The required return will be equal to the cost of capital, that is 8%, 0.08. And since the project is of 3 years, we'll write it minus 3. And may I know the present value? 2, 4, 6. May I know the present value? $17,464. Okay, now let's compare this figure with the required investment, which is $15,000. And since the required investment is less than what we should be investing, we should go for it. And the net present value is $2,464 positive. So we should go for it. Let's look at a different type of question. Again, we need to find out the net present value, but it's a bit different from what we've studied in the previous example. And may I know what's the difference between the question that we solved earlier and the question on the screen right now? May I know what's the basic difference between the previous question and this question? Yes, by and large, all of you are right. The basic difference is that in the previous example, we were getting $22,000 after the end of the 3rd year, and we were getting nothing after the end of first 2 years, that is year 1 and 2. But in this question, we are going to receive something after every year. Say, after the end of year 1, we are supposed to receive $10,000, and then after the 2nd year, we are going to receive $11,000, and at the end of the 3 years, we are going to receive $12,000. So we are going to receive amounts after every year. So we are not going to receive something after year 3 only. We are going to receive a series of payments throughout the life of the project. That's the main difference between what we have done in the previous question and what we are going to do in this question. So all we have to do is to calculate the present value separately for every cash inflow first. So we need to find out the present value of the $10,000 first, ignoring the rest of the 2. So the cost of capital is 10%, and the amount that we're going to receive after year 1 is $10,000. So may I know the present value of the $10,000? $10,000 into 1 plus 0.1 raised to the power minus 1. So may I have the figure for present value figure for year 1? 9091. Okay, it's 9091. So we need to calculate separate present values for every figure. So let's go and calculate the present value of the 2nd year figure, which is $11,000 with the same interest rate but with different year end, that is 2. So can I have the present value for the 2nd year? Approximately it's the same, 9091. I guess it's approximately the same. So let's calculate present value for the 3rd year. 12,000. 1.1 raised to the power minus 3. It's 9016. Yes, right. Now, these are the present values of different cash flows received in different years. So let's add them all together to get the total present value of the project. That is the total that company should be investing. 27198. 27198. Now 27198 represents the maximum that this company should invest in this project to earn its minimum required rate of return, that is 10%. But the actual required investment is 25,000, which is less than what maximum the company should be investing. So what's the difference? 2198 positive NPV, and since the NPV is positive, the company should go for this project. Got it? So should we take a break of 10 minutes? Yes, if the figure is different because of rounding off error, it's absolutely okay. Okay, so let's take a 10 minutes break. And what time is it now? It's 3:05. So we'll be back at 3:15, right? So we'll be back at it's break time. We will be back at 3:15 p.m. It's PST, Pakistan Standard Time, so make sure you are back on time. Welcome back. Now, can you just tell me the figures that we got, the present value figures we just got? $9091. Okay, good. Thank you. Next, it's again 9091, right? And it was 9016. Okay. And the total was 27198. 27198 and 2198. Okay. Okay. 9091 is actually the present value of the $10,000 that this company is going to receive after the first year. So if I want to calculate the present value of $1, how can I do so? If I say that 9091 is the total value of $10,000 and I need to find out the value of $1, how can I calculate? I'll simply divide 9091 by 10,000 to get the $1 value, right? Is it right? If I need to find out the present value of $1, I need to divide 9091 by $10,000 because 9091 is the value of $10,000. So to find out the value of $1, we need to divide it. So can I have the answer? .909. Okay. It's $0.909, right? So, and these $9091, this $9091 is the value of $11,000. So let's divide it with $11,000. So we'll get the value of $1 that is going to be received after year 2. 0.826. Good. And then 9016 divided by 12,000. So we'll come to know the present value of $1 that is going to be received after year 3. 0.751. So all these values are for $1. These are the present values of $1 at 10% rate of interest. At 10% rate of interest, and for different years. This is for year 1, this is for year 2, and this is for year 3. These values, that is the present values of $1 received at different time periods, are called discount factors. So a 10% discount factor for year 1 will be 0.909, 0.826, 0.751. So all these values are the $1 present values. So if we already know the present value of $1 and we are to find out the value of $10,000, all we have to do is to multiply the $10,000 with this discount factor, that is the value of $1, we'll get the total value. And in exams, we'll be given these values in the form of present value table, which is as follows. If you look at the 10% column showing the discount rate, and if you look at the number of years given in a row-wise arrangement, you'll see 0.909 for year 1, 0.826, and 0.751, which is the same that we have calculated previously. So you will be having this table for present values in the exam, and all you have to do is to pick the relevant discount factors looking at the discount rate and the years, pick up the relevant discount factors and multiply it with the cash inflows to get the present values. So it will make things much easier for us, and the problem that we were facing for rounding off the values and we were resulting in different, that the answers were different because of rounding off, it will no more be there, as you have to take these figures to calculate the present values. I hope the concept of discount factor is now clear. So if it's clear, then just go ahead and solve this question using discount factors. But before you people solve this question, I just need the discount factors, the relevant discount factors for year 1, year 2, and year 3. Just go to the discount factor table and tell me the discount factors from year 1 to year 3. So for year 1, you're saying it's 0.909. For year 2, you're saying it's 0.826. And for year 3, it's 0.751. So it has made things easier for us. All we need to do is multiply these figures together to get the present values. Good. So from now onwards, we'll be solving those questions using the discount factors rather than the formula approach. We can also calculate discount factor using the formula for discount factor, which is discount factor into 1 plus r raised to the power minus n. It's the same formula for calculating present value, only sum is missing because sum is 1 here. So whether we write 1 or not, it won't make any difference, therefore we don't write 1 here. So to calculate discount factor at any discount rate and for any period of time, we can use this formula. Should we move forward? Will we have the discount factor table in the exam, right? Yes, you will be. If you're going for the manual paper-based exams, your question paper will have those discount factor tables. And in case you are going for a computer-based exam, you will be provided with the present value tables in the software as well. Okay. Just calculate the net present value of this question. So it's 4425 net present value. So may I know what's the difference between the question that we have just solved and the previous question? Yes, all of you are spot on. You're right. In this question, we have uniform cash flows every year. That's constant cash flows every year. And if we have a project in which if we receive constant cash flows every year, such cash flows are called annuity. So it's an annuity project that is generating constant cash flows at regular intervals. So this is an annuity project, and what's good about this type of project is that we can use a simple approach to calculate the present value. And that simple approach is, say, we need to find out this value, right? Because 4425 is very simple. Once we have this present value of cash flows, all we have to do is to subtract the initial investment to get the net present value. So we need to find out 64425. So let's see how we have calculated this 64425 in this case. What we have done is we have multiplied 0.926 with 25,000 plus 0.857 multiplied with 25,000 plus 0.794 multiplied with 25,000. So if you see, 25,000 is a common figure in this whole calculation. So if we take 25,000 as common, we'll be left with 0.926, 0.751, 0.857 and 0.794. So we'll be left with the discount factors for year 1, year 2, and year 3. And if we add all these three discount factors, we'll get 2.577. And remember, 2.577 is actually the sum of these three discount factors. We can call it cumulative discount factor, or we can call it annuity factor. So this 2.577 is called annuity factor, which is actually the sum of discount factors from year 1 to year 3. And if we multiply this annuity factor with $25,000, we'll get almost the same present value that we calculated separately, which is 64425. So if we know the annuity factor, we can easily calculate the present value of any number of cash flows, provided that there are constant cash inflows. And how do we get this annuity factor? Just go back and see this another table that we have. There are two tables given on the slides. One was for the discount factors and the other is for the annuity factor. If we just look at the question, what's the discount rate in this case? It's 8%, right? So we'll just go back to the table and search for 8% column. Here is it, and see the third year annuity factor, which is 2.577. So since it was a 3-year project with starting from year 1, ending at third year, the annuity factor will be 2.577. So if we know this annuity factor, all we need to do is multiply this annuity factor with the amount of annuity to get the present value. But one thing should be kept in mind, that this is an ordinary annuity. That is, it is starting from year 1, which is something normal. Wherever we invest in a project, we usually expect our first profit or our first return or our first cash inflow to be generated at the end of year one. So it's an ordinary annuity. So annuity factor table is designed for ordinary annuity that is starting from year one. So just go ahead and calculate this one as well. If you see, this is again annuity here, but don't use annuity factor in this case. Just use this tabular approach to find out the present value. Just use this tabular approach, and don't use annuity factor at the moment. So this is the answer. Okay, tell me what's the difference between the question that we have just solved and the previous question. Because unless and until we know the difference between different type of questions, we won't be able to use the right approach to solve them. Yes, in the previous question, it was in an ordinary annuity and it was starting from year one. But in this case, it's starting from point 0. That is, the first cash inflow will be received at point 0, which is called advanced annuity. So this is something different from the previous example. Now, how will you use the annuity factor in case of advanced annuity? How are we going to use that approach? It makes no difference in the tabular approach. We have calculated the present value in the same way as we did it for the previous question. But when it comes to using the annuity factor, there will be a bit difference between what we did in the last question and what we are going to do in this question. And the difference is, first of all, we'll take the annuity, that is $15,000, and we will multiply it with the annuity factor. It's not a 3-year project, it's a 4-year project. Okay, it's a 4-year project. So we'll just find out the annuity factor for 4 years, since it's a 4-year project. So let's go back to the table and see at 8%, what's the annuity factor for year 4? It's 3.312. So just take 3.312 as our discount factor, 3.312. So had it been an ordinary annuity, this would have been the present value of the cash inflows. But since it's an advanced annuity, we have to add a further factor to this calculation, which is 1 plus R. So 1 plus R, R is 8% in this case, it's 0.08. So what we have to do is, we will just multiply 15,000 with 3.312, and then we will multiply it with 1.08 to adjust for the impact of advance payment. So can I have the final answer? 15,000 into 3.312 into 1.08. It's almost the same. 53654, almost the same. And then when we are going to calculate net present value, all we have to do is subtract the initial investment. So it's again the same, $13654. So this is something additional that we need to do in case of advanced annuity. Yes, Faizan, we can also add 1 to the third year discount annuity factor. So there can be multiple ways we can solve this question. So I'll stick to one. If you know any other way of doing the same thing, you can go for it. There's no one way of solving this question. There are multiple ways to solve this question. Well, there is no such rule that to what extent the answer can vary. But if you apply the right rules for the rounding off, the figures, your answer will always be considered as correct one, even if it's a bit different from other answers. In case of a descriptive part, that is a section C of the paper, the answer can vary because of different approaches being used. But in case of multiple choice question, you will always have 4 options, and you can choose the nearest one. So I hope the advanced annuity case is now clear. Okay. In this question, there is 3 years inflow. No, Madhya, it was a mistake. It's actually 4 years. I have made the correction. It's 4 years project, starting from point 0. So you can't usually receive 4 payments in a 3-year project. A 4-year project will always have 4 cash flows. Normally, it will have 4 cash inflows. Just go through this question and just solve it using the tabular approach first, and we'll see how we can use it using annuity factor. Excuse me. what's the total of present value of cash inflows? May I know the total of present value of cash inflows? Okay, it's 3. Okay. Now let's see and solve it using the Annuity factor approach, and I want everyone to listen very carefully because this is a bit tricky. So you need to watch it very carefully. It's a delayed annuity project, right? That is the first cash inflow which is usually expected to be received after year 1, but in this case it is going to be received at the end of year 3. So the cash inflows are starting from year 3. So this is an example of a delayed annuity project. So we discussed one ordinary annuity that is starting from year 1. We discussed another one which was starting from point 0, that is advanced annuity, and now we are discussing a project which is starting beyond year 1, that is from year 2, 3 years onwards. This is called delayed annuity. So in case of a delayed annuity, what we need to do is just follow this formula. Take the annuity, that is $14,000, multiply it with annuity factor. Now which annuity factor should we use? The project life is 6 years. Should we take 6 years or should we take any other annuity factor? Just listen carefully what annuity factor we are going to use in this case. The annuity factor for the number of payments rather than the project life. The project life is those 6 years, but we're not going to take annuity factor for the project life. We are going to take the annuity factor for the number of payments. So we need to calculate the total number of payments. 1, 2, 3, and 4. So the total number of payments is 4. And what we need to do is to go to the table. Discount rate is 10%. Go to the table. You'll go to the 10% column and pick up the annuity factor for year 4 rather than year 6. So the annuity factor in this case should be for the number of payments rather than the project life. So 3.17. So we'll multiply it with 3.17. And then we will multiply it with the discount factor. This time it's discount factor, not the annuity factor. And discount factor should be used for the number of years delayed beyond year 1. Normally the annuity is supposed to be received at the end of year 1, but in this case it is going to be received at the end of year 3. So how much delay is there in years? May I know the delay in years? Yes, it's a 2-year delayed annuity because we normally receive first cash inflow at the end of year 1. But in this case, the first cash inflow will be received at the end of year 3. So from the end of year 1 to the end of year 3, there are 2 years. So we'll say that the annuity is delayed for 2 years. So the discount factor that we're going to pick will be for year 2 because the delay is for 2 years. So go back to the discount factor table this time and not annuity factor. We'll go to the 10% column and we'll pick the discount factor for year 2, which is 0.826, and multiply it with 0.826. So first we need to take the annuity factor and then we need to take the discount factor. The annuity factor should be for the number of payments, that is 1, 2, 3, 4. So according to this project, there are 4 payments. Therefore, we'll take 4 years annuity factor and then multiplied with the discount factor, which should be equal to the number of years delayed. Usual annuity starts from year 1, whereas this one is starting from year 3. So there is a 2 years delay in the first payment. So we'll multiply it with 0.826. The answer will be approximately 36,659. So it's almost the same. There's $7 difference. Yeah. And then we'll just deduct the investment, and the answer will be 6,659, and approximately the same. Is it clear? Okay, just go ahead and solve the next question, which is again a delayed annuity case with different wording being used deliberately. So let's see how you can solve it. And make sure you use both approaches so that you can tally your answers whether the second approach is giving you the same answer as the first approach. So go for using both tabular and the formula approach. It will be for the whole week. There will be a 5 days revision session, and one session will be for mocks debrief. Yes, you will have to follow the same process that you used today with the same information, with the same link. So there will be no change. And even the time will remain the same for the first 5 days. And there will be a slight change in the timing for the mocks debrief. It will be on Saturday, but the timing will be a bit different. So you can go to the ACCA website and you can see the schedule for the debrief as well. But for the next 4 days, excluding today's session, timing will remain the same. Yes, with the first approach, the answer is 16378 negative. So let's go to the next approach and let's see how many of you can do it with the second approach as well. Because the second approach is the one that you're going to use in the exam, because you won't have enough time to solve a question. Say, for example, if a question is for 10 years, you can't go and calculate those present values for 10 years. So you need to use the annuity factor approach even for delayed annuity cases. But yeah, there will be difference in the answers using different approaches. So don't worry about that. So first we need to take annuity, which is 17,000. Then we need to take the annuity factor. Again, we need to take the annuity factor for the number of payments. The number of payments are 1, 2, 3, 4, 5. And if we don't have this table available, we can just calculate the number of payments from the question as well. It's an 8-year project, 8 years project, and it starts from year 4. So for first 3 years, you won't get anything. So if we subtract 3 from 8, we get 5. So it means for 5 years, we will be getting cash flows. So the number of payments can be calculated in this way as well. So let's go to the 12% annuity. Let's go to the 12% column in the annuity table and find out the annuity factor for year 5. 12%. And for year 5, it's 3.605. So we'll just use 3.605. And then we'll see the discount factor. It should be for the number of years delayed. So usually annuity starts from year 1. In this case, it is starting from year 4. So what's the delay in years? Yes, it's 3 years. So the delay in the inflows is 3 years. So we'll go back to discount factor table. It's annuity table. So go back to discount factor table, pick up the column, right column at 12%, and since the delay is for 3 years, we'll pick 0.712. 0.712, and just multiply these three figures. 17,000 into 3.605 into 0.712 is 4,365. $4,365. So it's approximately the same. There's a marginal difference between the two values, so it doesn't make any difference. And then we'll subtract 60,000 to get the net present value, which is $1,635. So in case of descriptive question and you need to make a decision of whether to accept a project or not, you just need to calculate the NPV, and right up below the NPV, just give a note, and by stating that since the net present value of the project is positive, the company should go for the project. Since the net present value of the project is negative, therefore the company should not undertake the project. So it will just simply be a single line identifying that since the project has a negative or positive net present value, therefore we should be either accepting or rejecting the project. So should we move forward? Okay, go ahead and solve this question. And this time it's you people who are going to solve the complete question. And once I get at least 5 answers from you people, only then I will solve the question. Sayyid Muhammad, I don't know, what do you mean by table? Can you just elaborate your question? Very quick, Sufyan. But use both approaches, Sufyan. Use both approaches. Use the tabular approach and then use the formula approach. Okay, I will go for the formula approach. So we'll pick up the annuity first. That is $14,000. Annuity factor, the cost of capital is 10%. And how many payments are we going to receive? Wording is a bit different here. It says that the project is expected to generate cash inflows of $14,000 per year for 5 years. So it's clearly mentioned in the question that you will receive payments for 5 years. It means that you will have 5 payments starting from year 3 onwards. So we'll just pick annuity factor for year 5. So let's go back to the annuity table and see at 10% cost of capital in year 5 we have got 3.791. 3.791. So this is the factor that we will be using, 3.791. And then we'll see the discount factor. Again, it is starting from year 3. It means there is a 2 years delay in the cash flows. So go back and see the discount factor for year 2. At 10% is 0.826. This one. 0.826. So what's the answer? Multiply by 3.791. Multiply by 0.826. So it's 43839. And then if we need to find out the NPV, it will be 43839 minus 50,000. $6,161 negative. So we have covered different situations of annuity now. We covered the ordinary annuity starting from year 1, the simple form. Then we covered the advanced annuity that is starting from year 0. And now we've covered delayed annuity that is starting from any year beyond year 1. Any questions before I move to next slide? Sufyan, we have discussed it in detail earlier. If you have any problems, we can discuss it at the end of the session today. Shakil, at the moment, I can't refer to you to any question because we are just trying to build the base for investment appraisal. So we have solved simple questions at the moment, and in tomorrow's session we'll be attempting the NPV's comprehensive questions, descriptive type of questions, which will include everything. So we'll discuss it tomorrow. As what if NPV exactly equals to the maximum investment? NPV exactly equals, or you mean that present value of cash inflows equals the amount of investment? Is that what you are asking? Okay, if your total present value of cash inflows is equal to your present value of cash outflow, it means that you are going to have a zero NPV. So at zero NPV, the company will actually be indifferent whether to go for the investment. The preferred way will be to go for any other project that generates positive NPV. But sometimes, I'm talking about from practical point of view, it's definitely in an exam question, it's least likely that you will get a zero NPV and then you'll be asked to take a decision, because you can't take a decision at that point where the NPV is zero. But from the practical point of view, if a company gets a zero net present value, the preference will be to go for a project that has a positive NPV. But in case the company does not have any such project and does not see any such project in the foreseeable future, then it's better for the company to go for that project, because at least it will be able to satisfy its investors. Even if not growing, at least it will be able to satisfy its investors. But as far as possible, the company will be searching for positive net present value projects. Okay, any other question? Okay, no questions are coming up, so I assume that there are no further questions. I will move forward to our next topic, and it's perpetuity. What is perpetuity? When a cash inflow, a series of cash inflows continues for indefinite period of time, these cash flows will be called as perpetuity. That is something that will last forever. So, for example, if a shareholder is going to buy a ordinary share of a company, it's going to receive dividends for a foreseeable future, and it will have no definite period of time till the time he holds the share, he will be going to receive the dividends. So it's almost, you can say, he's going to receive the dividends forever. So such cash inflows are called perpetuity. Now, how can we calculate the present value of a perpetuity? That is a cash inflow that is going to be received forever. Now, I'm just solving I'm just trying to derive a formula for calculating present value of perpetuity, but remember, this is not examinable. The derivation of the present value of perpetuity formula is not examinable. So it's just to explain how the formula has been derived so that you know better how to apply this formula in exam question. You all know that to calculate present value of annuity, we need to multiply annuity with annuity factor, right? And the formula for calculating annuity factor is 1 minus 1 plus r raised to the power minus n divided by r. This is the formula for calculating annuity factor. So when we say present value of annuity, it means the project has a definite period of time. This is what we have assumed, that the project will have a definite period of time. That is, maybe the project is of 5 years, 4 years, 3 years, 10 years, 8 years. So we've assumed that. So that's why the power is minus n, that is a definite value. But if we say we need to find out the present value of perpetuity, it means the project has infinite life, or we can say that the cash inflows will be received forever. So how we can calculate the present value of such cash inflows? So we'll take annuity, and instead of annuity factor, we'll write the formula, that is 1 minus 1 plus r. And instead of writing minus 1, we'll write minus infinity, because the number of years is infinite, divided by r. Is it right? I hope you've understood so far what have been discussed. Okay, now let's try to simplify this equation. Let's try to simplify it. I want you people to hold the calculators in your hands and do some calculations for me. Suppose that the discount rate is 10%. 10%. So what will be the answer of this bracket only? 1 plus r raised to the power minus infinity. If the discount rate is 10% and the project life is 1, so what will be the answer of 1 plus r raised to the power minus 1? Can I have the answer? It will be for year 1, right? So I'm assuming that the power sign is 1, 0.909. And I want everyone to solve this and follow me. 0.909, right, excellent. Suppose that the project life is 2, that is, the cash flows will be received for 2 years. So what will be the answer of 1 plus r raised to the power minus 2? So if I increase the power sign to 2, it's 0.827. And what about if I write 3 there? .751. Okay, what pattern are you observing? Decreasing discount factor. So it means if the number of years is increasing, the answer is decreasing, right? So if I keep on increasing it, the answer will keep on decreasing, and there will be a point where the answer will be 0, right? So if I raise the power to infinity, the final answer will go down to 0. So can I write 1 plus r raised to the power minus infinity as 0? Can I write like this? Yes or no? Agnes says cannot. Why cannot? If I raise the power, I increase the power, and the answer is decreasing, there will be a point when the answer will be 0. So if it is raised to the power minus infinity, the final answer will be 0. So I can write it like this: annuity into 1 minus 0 divided by r. And if I further simplify this, 1 minus 0 is equal to 1, 1 into annuity is equal to annuity, and the final, the simplified formula will be annuity divided by r, that is the present value of perpetuity, will be calculated as annuity divided by R, and here is the formula. But make sure you are aware that this formula will be used for an ordinary perpetuity. So the most simplified form of calculating present value of perpetuity will be the annuity divided by R. Is it clear to everyone? So remember, this derivation is not examinable. It's just to enable you to apply this formula in the exam question so that you know that how has this been derived. So to calculate the present value of perpetuity, which is starting in 1 year's time, will be just the annuity divided by the discount rate. And remember, it's the discount rate, not the discount factor. So you just need to put the discount rate. For example, if it's 10%, we need to put 0.1 rather than going into the discount factor table. But what if it's the advanced perpetuity, like we had advanced annuity? The formula, that is annuity divided by R, will be only applied to a situation where the perpetuity is starting from year 1. That is, the first cash inflow is received after year 1. So all we have to do is to divide the annuity by the discount rate. But what if the perpetuity or annuity starts from year 0? That is, we receive the first inflow at 0.0. In that case, we need to calculate the present value of perpetuity as it starts from year 1, that is annuity divided by R, and then we will multiply it with 1 plus R to incorporate the impact of advanced perpetuity. So when it starts from 0.0, all we have to do is multiply it with 1 plus R. But in case of delayed perpetuity, that is where a first cash inflow is received from year 2 or 3 or onwards, then we'll again calculate annuity as if there is no delay, that is annuity divided by R. We'll calculate present value in a simple way. But then we have to multiply this figure with the discount factor in the same way as we did it for delayed annuity. But the discount factor should be for the number of years delayed beyond year 1, in the same way as we did it in case of delayed annuity. So there will be 3 variations in case of perpetuity. 1 starting from 0.1 from year 1 and continues till ever. Secondly, it starts from 0.0 and continues forever. And thirdly, it starts from year 2, 3, or 4 onwards and continues till ever. So there are 3 variations in a perpetuity case. Madiha, what are you saying? Formula of perpetuity is 1 upon R. Is it right? No, it's not 1 upon R. It's the form. You can say it's the formula for perpetuity factor. You can say 1 upon R will give you the factor for perpetuity, and then you have to multiply it with annuity to get the present value of perpetuity. So yes, you are right. If you mean that how we calculate perpetuity factor. Is there any need for the break? Do you people want me to give you a break for 5 minutes? Okay, enough of votes. Decided. There's no break. So Here are the 3 questions covering 3 different situations. Just go ahead and solve these 3 questions using these 3 those 3 approaches. The first example is for the ordinary perpetuity, the second example is for the advanced perpetuity, and the third example is for the delayed perpetuity. So solve these 3 situations and you will know what I meant earlier. Yes, answer for example 1 is positive NPV of $10,000. The present value of cash inflows will be $60,000. And if we deduct the initial investment from $60,000, we'll get $10,000 as positive NPV. So 6,000 is the value of annuity divided by the discount rate 0.1. This will give us the present value of cash inflows, and then we'll deduct the initial investment, that is $50,000, and the answer will be $10,000. For the second one, we'll divide 8,000 by the discount factor, which is 0.08, sorry, discount rate, which is 0.08, and multiply it with 1 plus R, 1 plus 0.08. This will give us the present value of cash inflows. Then we'll deduct initial investment, which is 60,000. So 8,000 divided by 0.08, this gives us 1 lakh into 1.08 minus 60,000. It's $48,000. Again, for the second one, it's a delayed annuity, so we just need to calculate the present value of inflows first. 9,000 divided by 0.08. Since there is a delay, we need to use discount factor. It's starting from year 4. May I know what's the delay in years? Yes, I asked. Excellent. It's 3 years delay, so we need to find out the discount factor at 8% for third year. May I know what's the discount factor for the third year at 8%? 0.794. Okay, we'll multiply it with 0.794 to incorporate the impact of delay, and then we'll deduct the initial investment, which is $40,000. So 9,000 divided by 0.08 multiplied by 794 minus 40,000. It's $4,932.5 positive. Yes, absolutely right. So it's It's clear now? Yes, these are ideal questions for multiple choice questions. Okay, let's move forward. Another investment appraisal technique is called the internal rate of return, IRR. It's again a technique used for appraising projects, and the IRR of a project also gives an indication to a company for whether to accept or reject a project. The difference between NPV and IRR, well, there are multiple differences, we'll discuss it later, but the basic difference between NPV and IRR is that NPV is expressed in monetary terms, that is, it has an absolute value, whereas IRR is expressed in percentage terms, that is, it has a relative value. So this is a basic difference between NPV and IRR. So let's look at what IRR is. If you look at the definition, it's the discount rate at which NPV of the project is 0. It is the definition of IRR, but I don't think it's clear enough to tell you what IRR actually is. So we'll just get back to this definition later on. First, we need to find out how we calculate IRR and what actually IRR is. Then you will understand what this phrase or this definition mean. A project, let's look at this example. Forget about this formula at the moment. Don't look at the formula at the moment. Just look at this example. A project has following NPVs at two different discount rates. $2,000 positive at 10% and $500 negative at 15%. Now, what does these values mean? If we discount a project at 10%, it gives us a positive NPV of $2,000. What does this indicate? Does it indicate we are earning more than 10% or earning less than 10%? Yes, if we use 10% as our discount rate and calculate net present value, and if it turns positive, it means we are earning more than 10%. But at the same time, if we discount it at 15% and it gives us a negative NPV, what does this indicate? Less than what? Less than 15%, yes. And if a project has positive NPV at 10% and negative NPV at 15%, what does this imply? What does this imply? What does this tell us about the project? I'm waiting. If a project has positive NPV at 10% and negative NPV at 15%, what does this tell us about this project? It means that the project is generating a return in between 10 and 15%. It might be 11%, 12%, 13%, 14%, 14.5%, less than 15, but more than 10%, anywhere in between these two values, right? It means that if we have a cost of capital of 10%, we should go for this project because this is getting us more than 10%. Is this right? But if we have a cost of capital of 15%, we should not go for this project because this is generating less than 15% and we'll be having a negative NPV. Yes. So the decision rule will be to accept this project only if your cost of capital is 10% or reject it if it's 15% or higher. Okay, so 10%, we have $2,000. 15%, we have a negative of $500. So it means that the project's rate of return is somewhere in between 10 and 15%. And the rate will be the one at which the NPV is 0. If at any point we get a 0 NPV, that rate of return will be, that discount rate will actually be the rate of return of the project. For example, if I say if we raise the discount rate to 11%, we are still getting a positive NPV of, say, $1,600. Though it's less than the previous, but it's still positive. It means we are earning more than 11% because it's still positive. And if we keep on increasing it, and reach to a point where the NPV turns 0, we'll say, this is, hey, stop, this is the point, and this is the rate at which we are earning. For example, I'm just assuming roughly, if we raise it to 13% and the NPV turns 0, what does this tell us? This tells us that this project is generating a 13% return. That's why when we discount it at 13%, we get nothing. It's just 0. So this is the rate of return of the project, and do not accept any project if the company has a cost of capital of 14%. Because if at 13% we don't save anything, at 14% we'll definitely be at loss. So 13%, I've just assumed this 13% figure. This 13% figure at which the NPV is 0 is telling us that do not accept this project if your cost of capital is higher than 13%. But do accept this project if your cost of capital is less than 13%. So this is how IRR gives you an indication of whether to go for a project or not. So if now, what should be the decision rule in case of IRR? Except when your IRR, when the project's IRR is greater than cost of capital of the company, and vice versa. That's how IRR helps you in deciding whether to go for a project or not. So what we are going to do is to find out the rate at which NPV will be 0, and we'll make sure that we don't accept any project if our cost of capital is above this rate. That's why we say IRR is the discount rate at which NPV is 0. So how to find out that rate in which the NPV will be 0? To calculate this, we first need to assume that NPV and IRR will have a linear relationship. That is, the NPV and IRR will change in same proportion every time. At the moment, we can see there is an inverse relationship between discount rates and NPV. If you see, increasing the discount rate is reducing the NPV. So it shows an inverse relationship between discount rates and NPV. And we will assume that there will be an inverse linear relationship between these two variables. Yes, Adil, if our cost of capital is 14% and IRR is also 14%, it means that we are at break-even. We won't be saving anything. Okay, let's see how we can find out discount rate at which NPV will be 0. Just look at this information and let's see. how the NPV of the project is changing with the change in the discount rates. Sufyan, we will assume that what is meant by, we will explain what is meant by linear relationship in a while. Just forget about what linear relationship is at the moment. We'll discuss it in a while. Let's see how we can calculate it. Just look at this question and see how much variation in NPV is there. According to this question, how much variation in NPV is there? May I know what's the total variation in the NPV in this case? It's 2,500? Yeah, it's 2,500. It's not 1,500 because from positive 2,000 to negative 500, the total variation is $2,000. And we can also calculate in this way, 2,000 minus 500. To find out the variation, it will be 2,500. So the total variation in NPV is $2,500. And what's the total variation in the discount rate? It's 5 percentage points. We have varied the discount rate. We have increased the discount rate by 5 percentage points. Okay. So can we say that this variation is a result of 5 percentage points variation in discount rate? Yes. And if we need to find out the variation in NPV per percentage point, how we can do that? If 5 percentage point variation in discount rate has changed the NPV by $2,500, how can we find out the variation in NPV per percentage point? Division, yes. We'll divide 2,500 by 5 to find out the variation in NPV per percentage point in discount rate. It will give us a relationship of NPV and discount rate, which is 500. And this is where we will assume that for every 1% change in discount rate, the NPV will change by $500. And this is why we have assumed a linear relationship. In practice, NPV does not change with the discount rate in the same proportion. But to make our calculations simple, we have assumed that each time when we will change our discount rate by 1 percentage point, it will result in a change of $500 in NPV. So it is going to make our calculation simple. But in practice, it will change in, maybe it won't change in the same proportion. Okay, so 1 percentage point in discount rate is bringing a change of $500 in NPV, and remember there is an inverse relationship. It means that when we will be increasing our discount rate, our NPV will be reducing. And if we increase our discount rate by 1 percentage point, our NPV will reduce by $500. Is it clear? Yes. Okay, if we pick this NPV, that is $2,000. $2,000. It's positive at the moment, right? And each time NPV changes by $500. $500. Now my question to all of you is, how many times do we have to change this NPV so that it becomes zero? Each time that it changes by $500. So 500, we'll divide 2,000 by 500 to get the number of times that NPV needs to change before it becomes zero. It's 4 times. So 500, if first it will be $2,000. Then it will change by 500. That is, it will be reduced by 500. It will come down to 1,500 once. Then it will reduce by a further 500, and it will be down to $1,000. 2 times change. Then 500, and then 0. So we have to change this NPV 4 times before it turns 0. 4 times, right? Is it clear? And each time if we want to change this each time, we have to raise the discount rate by 1 percentage point. So if we change the discount rate 4 times, the total change in discount rate will be 4 into 1 is equal to 4%. So if at the moment the discount rate is 10% and we need to raise it by 4% to make the NPV 0, it will become 14%. It means that we have to raise our discount rate to 14% if we want 0 NPV. Is it okay? So at 14%, our NPV will be 0. And this indicates the rate of return of the project, that is the IRR of the project. And let's now use the formula approach to calculate the IRR. And let's see if we get the same answer or not. Let's go back to the formula and see what are these variables. A is the lower rate. So of the two rates, which one is the lower rate? $10. Okay, let's put it 10. A is the positive NPV. Of the two NPVs, which one is the positive one? 2000. So we'll place it in the numerator. Okay. Then again it's A, 2000. Then it's plus. Actually the formula is, it's not plus, it's minus. So eventually it will be added together, because if we write minus and then we write minus 500, that is the negative NPV, these two values will be eventually added together to give us the sum of the two. Then multiply it with B minus A. B is the higher rate, which is in this case 15%. 15 minus 10. So if we solve this, do we get 14%? So it means we will only accept this project if our cost of capital stays below 14%, because at 14% we'll save nothing. So if we want to accept this project, we'll make sure that the cost of capital is less than 14%. Because if you use cost of capital of 14%, the NPV will be 0. So you don't need to use this approach to calculate the IRR, definitely. You need to use this formula to calculate the IRR. This was just to make the concept more clear. I hope everybody understands what IRR is and how we calculate it. Any questions? At 14%, we will be indifferent. If the cost of capital is 14%, it means it's just the project is just good enough to cover our cost of capital. So it's up to us. It's up to the company to see whether they want to save further, or they're good. They're satisfied with 14% return. It means that we should go to the project with lowest 14%. Adil, it means that the cost of capital needs to be below 14% in order to accept the project, because project is giving you 14%. Now, if you are giving away to your investors more than 14%, this project is not going to help you. So if your investors are asking for a higher return than 14%, and the project is just giving you 14%, from where will you compensate that additional return? Definitely you will have to use your reserves, and you will never want to. No, multiple IRRs, you won't be tested on multiple IRRs. Multiple IRRs is just in case we have non-conventional cash flows. We'll discuss later. Ayaz, it's a good question. How will we get 2 NPVs? We'll just go to the next question. It'll tell you how we get 2 NPVs. Thank you, Sumer. And you people can give your feedback regarding the session, the so far session. Should we move forward? Okay, this is the same example that we solved for NPV earlier. This is the same question that we solved for NPV earlier. If you could just go back to example 3 when we were solving NPV, and can you just tell me the NPV of the project at 10%, because we already calculated it at 10%. So can I have the NPV of this question at 10%? I hope everyone is following me at the moment. I just want you people to go back to example 3 when we were solving it for NPV, and we solved it for 10% cost of capital. So can I have the NPV for 10%? It's 2198, right? Okay, so it means that we already have one discount rate and one cost of capital, and since it's positive, so we can say we have A% available, which is 10, and we have capital A available, which is 2198. So there are 4 variables in the formula, and of the 4 variables, we already know 2 of them. Now we need to find out the other 2 variables, that is B% and capital B, the negative NPV. So if we know that the NPV has an inverse relationship with the discount rate, so if at 10% we have a positive NPV, what do you think what we should do in order to bring a negative NPV? Should we take a higher discount rate than 10%? Or should we take a lower discount rate to get a negative NPV? Obviously, we need to take a higher discount rate to make it negative. So what that higher discount rate should be, there is no rule for it. You can take any higher value, but all you have to do is to make sure that the NPV is negative. We don't get another positive NPV. That's what we have to avoid. So we need to take a higher rate that ensures a negative NPV. Let's take 20%. Yeah. Thank you, Ikrar. Let's take 20% as our another discount rate. So let's take B% as 20%, and let's see what NPV do we get. So just go to the discount factor table and pick the discount factors for 20% and tell me what the discount factors will be at 20%. .833. Next one. 0.694. And the third one, 0.579. Okay. So multiply these figures and just tell me the present value of cash inflows, the total of the present value of cash inflows. Just tell me the total of the present value. 22912. Okay. Okay, so here we go. We have got the negative NPV. But I know what's the negative NPV. It's 2088. Okay, thank you. 2088 negative. So now we have got the negative NPV 2088. We've got the positive one, and all we need to do is to put these figures into the formula to get the IRR. So 10 plus 2198 divided by 2198 minus 2088, and they will eventually be added together, and then 20 minus 10, and tell me the final answer for IRR. It's 15% approximately. Okay, good. So I hope the concept of IRR is now clear. Yes, it's around 15%, so it's 15%, you can say. So there's nothing new about IRR. All you need to know, all you need to calculate is the two NPVs, one the positive one and the other the negative one. And once you are done with those calculations, you didn't need to put in the formula to get the IRR. So what you do is you just go back to the previous slides where we calculated the NPVs, and at home you just go and calculate the IRR for all those questions for which we calculated NPV. So it will be, you can say it's a home assignment for you to go back to all those questions for which we calculated NPVs and calculate IRR for those. Oh, Sufyan, the 15% itself is a return. 15% is the return from the project. Now what you need to do is to compare this 15% return of the project to the cost of capital of the company. If the cost of capital of the company is less than 15%, it means you are saving, because project is giving you 15% and you are giving away to your investors less than 15%, so you are actually saving. A plus in the formula, or is it B plus? Can you just elaborate your question? B plus, what do you mean by B plus B, A plus in the formula? Okay, B is 10. B is not 10. B should always be the higher rate. A is the 10 because A is 10%, whereas B is the higher rate, 20%. Oh, I'm so sorry. I'm so sorry. It's my mistake. Thank you for correcting me, Michelle. Thank you. Okay, that's it for today. I hope you have understood whatever has been taught in today's session. And I hope you people are okay with the pace that we have used in the session. Yes, my tomorrow session will be on the advanced NPV calculations. Yes, the session for tomorrow will be the same. It will be the same for the rest of the 4 days. Okay, on the screen, we'll be sharing my contact details with you. There will be a link to my YouTube channel, and there will also be a link to my Facebook group. Do join that Facebook group, and I will be sharing the WhatsApp link on that group today, from which you can join the WhatsApp group, and you people can ask me questions on that WhatsApp group. You can share your queries with me on that WhatsApp group. So do join my YouTube channel and my Facebook page today. I'll be sharing the WhatsApp group link on that Facebook page today. Not on FB. Okay. Okay. Tomorrow I'll be sharing the link of WhatsApp group on the same platform as you are here today. So no problem. Even if you are not on the on the Facebook, I will share those the group's link tomorrow with you people. And you people, one more thing you people can do today is that you just go back to your revision kits and try solving MCQs regarding investment appraisal, in which you'll be asked to calculate NPVs and IRR. So you'll come to know that how NPV should be examined in the exams in the MCQ section. So we have 5 more minutes, and you may ask questions. Yes, the simple NPV questions you will be able to solve by us. The simple NPV questions, which do not involve any complex calculations. So the simple NPV calculations, you'll be able to solve those questions. Terminal value is actually the scrap value of any investment. When at the end of the useful life of investment, if you sell an asset, that value of the asset will be called terminal value. So when most probably the forex will be at the end of it probably will be on Friday, I guess. Ali, I don't know what the exact NPV is, because we have just relied on the information provided by you people. It doesn't make any difference. We have assumed that the positive NPV is 2198. So you can go back to the third example we solved when we were calculating NPV. You can pick the right NPV from there if it's not the right one. Tomorrow we will be going for the calculation of advanced NPV. The type of questions that you may face in the descriptive section of this of the paper, that is section C. So we'll be solving the advanced NPV calculations or problems. Fahad, whenever you face any problems in any area, the only way of removing the problems and removing the weaknesses is to practice more and more. Just go through the MCQs as much as possible, and this is the only way that you can improve yourself in the MCQ section. You can go for for the revision kits of Kaplan, BPP, Becker. You can use those revision kits for MCQ practice. Yes, it will be investment. So, yeah. Ikrar, you may go for any book. Both cover the complete syllabus, and it's totally up to you. Just look at your own convenience. Okay, everyone. Thank you very much. We'll be meeting tomorrow at the same time. Till then, bye-bye. Have a good day.